two values from the balance sheet. Shareholders fund also you can take it from the balance sheet, as well as the total assets is also available in the balance sheet. We have a shareholders fund formula very clear. All the type of equity and preference shares, then the reserves and surplus, that is retained earnings, but the fictitious assets must be deducted if it is given there. This is a shareholders fund formula. And in case of total assets, the total assets except fictitious assets. So if you are going to take all the assets of the asset side, the fictitious assets must be removed from it. And if you are not going to consider fictitious asset, so the except fictitious assets, all the remaining assets would be considered for the comparison of this. This ratio reflects as the position of the how much amount of ownership fund, including preference share capital, invested in the total assets. That means what is the contribution of the shareholders' investments in the total assets. Why it is to be shown? Because of it is one of the parameters for find out the company's owners have more investments in the total assets rather the borrowed fund and the third party fund has invested into the total assets. And if it is almost very close to 60% or more than 60%, it reflects that the company have enough command in the business that their investment is more than the borrowing fund, and that's why these ratios is find out. Ultimately, it shows a strength, and we can consider it as a part of the positions of the company. Honors positions of the company is very stronger. So this ratio reflects that situation. See here, on the basis of the valuation of balance sheet, see the shareholders fund. According to my calculation and my knowledge, the 20 lakh rupees we have equity share capital, plus 20 lakh rupees we have a preference share capital. Okay, 11 lakh rupees we have that is a part of retained earnings, and as well we have a fictitious assets also, that is 1 lakh rupees. So the shareholders fund comes to around 50 lakh rupees. This is a shareholders fund. Now see the balance sheet asset side. The total value of the asset is given 64 lakh rupees. The total amount of the balance sheet comes to 64 lakh rupees. But it is including the fictitious assets. So now the fictitious assets would be removed from it, 1 lakh. So the balance sheet is total assets shows in the balance sheet it comes to 63 lakh rupees. So now you see the total assets and shareholders fund, two variables are supposed to be compared, and that is actually compared to show the strength of the owners in the business. It reflects from this two value very clearly the company in the company shareholders fund have enough control under the total asset, but we need to find out in the values how the value has been designed. This ratio will be find out in the proportion. So here it's 50 lakh divided by 63 lakh, and this comparison shows, as I already told you, when you are find out the proportion, your denominator is always comes base, and base is 1. So now division between these two, it comes to 0.79. Just confirmed it. Its value of difference is 0.79, and the 0.79 is to 1. It shows that the almost 80% or almost 0.79 of total 1 has been invested by owners, equity shareholders and preference shareholders. That means the very good command controlled having by the owners in these total assets as well as in the company. So this is what all about the proprietary ratio. Now moving to the next segment, and that is profitability ratio. But the profitability ratio is on the basis of return on investments. It is not on the basis of sales. So this is very important part of the concern things. Let's see how this profitability ratio would be helpful and find out the information. I think I already expressed all these three ratios to you, and these three ratios we determine at the time of the concern requirement. See here, I'll just make something working for you. and this working would be very much helpful to understand how this ratio would be calculated. For that, we will prepare the revenue statements in a vertical format. Revenue statements in a vertical format, and these revenue statements would be helpful to evaluate the business position. So now let's begin with the information, that is why I actually asked and prepared these things, because of, if you observe that there are actually in the question there are two ratios only, but I am going to find out all the three ratios of a profitability, that is return on capital employed, ROCE, that the formula for that is EBIT upon capital employed, then ROSHF, return on shareholders fund, that the value is profit after tax divided by shareholders fund, and the third is return on equity shareholders fund. Formula is that PAT minus preference dividend and divided by equity shareholders fund. So there are three formulas. If you are going to refer all these three formulas, then there is a certain values is given. This is PAT, profit after tax. So if you are going to see, there are three different profits you need. One is EBIT you need, then the profit after tax is need, and the another is profit after tax minus preference dividend. So ultimately the three layer you need to calculate all these three ratios. So let's see, we will find out the one by one all the three ratios, but before that we will do it the one working, where in this working all these three layer would be identified. Now all of you refer your revenue statements, and the revenue statement starts with the sales. The sales value is given 15 lakh rupees. Less, from the sales you can deduct the cost of goods sold, and cost of goods sold is given 7,50,000 rupees. So the balance is comes to 7,50,000 rupees, and that is your gross profit. This is your gross profit. Now gross profit would not be considered here anywhere, but next is operating expenses, less operating expenses. But when you are going to see in the question, there are two operating expenses. One is admin expenses and other one is selling and distribution expenses. Admin expenses is given along with the interest on debenture. Interest on debenture, it's a financial expense. A financial expense cannot be considered under the heading of operating expense. So what we did actually at that point of time, when we find out the operating ratio, we removed interest on debenture from it, and the remaining admin expense was considered. The same thing we are going to do it here. So admin expense is given in the question 1,25,000. Debenture value is 10 lakh rupees. So the 10 lakh rupees debenture value at the rate of 10% interest, it comes to 1 lakh rupees. So from 1,25,000 admin expense, interest on debentures removed from it, remaining admin expenses are 25,000. And see that selling and distribution expenses, that is 1,25,000 rupees. So it comes to total operating expense is 1,50,000. So the total operating expense is 1,50,000 rupees. Deducted from the gross profit, your balance is 6 lakh rupees, and this balance is considered a part of EBIT or operating profit. Whatever you want to say, you can say that is EBIT or an operating profit so far. Now EBIT, it means it's an earning before interest and tax. It means that the company have a profit before interest and tax. It means the two things to be deducted from this profit. One is interest and the other one is tax. Interest value which we have already, which was already given in the question along with the admin expenses, that is interest on debentures. So now we will deduct interest on debenture. Interest on debentures which we were calculated on 10 lakh rupees, 10% comes to 1 lakh rupees. So your interest on debenture is 1 lakh, deducted from it the remaining balance, it's EBT, earning before tax only, because of the interest is already deducted. Now this EBIT would be helpful to calculate it here. So one answer we got it. This is to be used for the calculation of return on capital employed. Now see further. The next is earning before tax. That means earning before tax, we need to identify the how much amount of the tax liability is there. See again revenue statements, there is a question and there is the information which was very clearly mentioned. The tax liability is 50% of that. Tax liability is 50% of this. So which comes to 2,50,000 rupees. So the remaining balance, it's 2,50,000 rupees, that is profit after tax, and that is your second value which would be helpful to find out the profitability of return on shareholders fund. So return on shareholders fund formula is profit after tax divided by shareholders fund, and then from the profit after tax you just calculated preference dividend. The preference dividend, you can determine that preference share capital is 20 lakh and the dividend rate is 10%, it comes to 2 lakh rupees. So the 2 lakh rupees preference dividend deducted from it, the balance of divisible profit, it comes to 50,000 rupees. Then this would be your third part, helpful to determine your return on equity shareholders fund. So in this regard, you can consideration this revenue statement would be helpful, that how these three ratios can be identified. So as per this revenue statement calculations, now we will calculate it one by one all the three profitability ratios or return on investments. Ultimately it's a return on investments because of we have actually divided the denominator is actually investments, and this calculated with the profitability of the company. So let's begin with the first ratio, that is return on capital employed. In case of return on capital employed, the differences is actually find out between EBIT and capital employed. So earning before interest and tax we find out in the revenue statement, and that is 6 lakh rupees. Now this 6 lakhs would be compared with the capital employed. The formula of capital employed is equity share capital plus preference share capital. So both the ownership funds are included here. Then the borrowed funds, so long-term outside funds, all the long-term liabilities include bank loan, debentures and financial institution loan, whatever it is given in the balance sheet. Then reserves and surplus, right, all the retained earnings of the firm, and at minus fictitious assets. So it means that the capital employed to be find out in this way. Here just refer all of you balance sheet, and from the balance sheet informations we will find out all the values from the capital and liability side. See here, equity share capital is given 20 lakh rupees. Then the preference share capital is also given at 20 lakh rupees. Long-term funds, if you are going to refer, the long-term funds is only one, and that is debenture, which is 10 lakh rupees. Then reserves and surplus is there, that is 11 lakh rupees. Total amount of reserves and surplus, and fictitious assets, it's 1 lakh rupees. So the balance of all this, it's very close to come to around 60 lakh rupees. So total amount of capital employed is rupees 60 lakh. So now 60 lakh rupees would be compared with the amount of EBIT. So here 6 lakhs is your EBIT and the 60 lakh rupees it's your capital employed. This ratio is find out in percentage. So when you compare these two items with the percentage, your answer would be 10%. It means the company have a 10% return on their total amount of investments. This is a return of your investments, which shows that whatever the amount investment made by the company in the firm, whether it is an ownership fund or a borrowed fund, they got a return, and this is an actual, this is a 10% return. Fine, according to the standard, if you are going to compare, this maybe looks like a little lesser, because of from this 10%, two important things are going to deduct. One is now this is an analysis. So here two important items. One is interest burden, which is going to remove from it, and the second is the tax liability, also going to remove it. So that means two important things to be deducted from it. Maybe this percentage will goes down from this level also. So the margin which you are receiving for operating concerns, which is according to the knowledge, it is little lesser. So this is what the amount of return on capital employed. Now let's see. We'll find out a return on shareholders fund. So return on shareholders fund formula is profit after tax divided by shareholders fund. Profit after tax we already determined here, that is 2,50,000 rupees. And the shareholders fund formula, which was already used in many ratios, equity share capital plus preference share capital plus reserves and surplus, that means retained earnings, and then minus fictitious assets. So see here, equity share capital which was given 20 lakh rupees here, preference share capital is also 20 lakh rupees, reserves and surplus is 11 lakh rupees, fictitious asset is 1 lakh rupees. So in short, the amount of shareholders fund remaining after deducting of fictitious assets, it's very much close to 50 lakh rupees. That is 50 lakh rupees. Now see here, this 50 lakh rupees, it's a total investments made by only owners, promoters investments, including preference share capital, but ultimately preferences is also partially ownership fund only. So that's why it is including preference share capital, it's 50 lakh rupees. Now this would be compared to your profit after tax. Profit after tax is 2,50,000 divided by 50 lakhs into 100. Now if you are going to divide, the answer would be coming, it's 5%. 5% return on your investments made by the promoters. That means the investments made by the shareholders or a plowing back of, including the reserves and surplus, that is plowing back of profit, only 5% return on their investments. So ROI so far as concerned of this segment is only 5% and this is 10%. That means the comparison between these two, it shows that the 5% of your operating expense, 5% of your difference between the EBIT and PAT has been contributed by only two items, that is interest and tax. It shows that your profitability has been actually evaporated through the financial expenses and the provision for certain amount. So that you need to control and find out what are the steps to be taken for the improvement of this return on shareholders fund. My observation and my analysis said you need to improve your EBIT more, and if you are going to